COVID-19 continues to rage across the world in the new year, with the global caseload topping 89.5 million over the weekend. Nearly a year since the pandemic was declared, it seems there's a long way to go until lockdowns and restrictions on economic activity can be loosened, even with wide-scale vaccinations taking place now in major economies. It won't be business as usual for the foreseeable future. In fact, industries and government authorities are beginning to shift to the new normal in terms of business and global trade. And we discuss what lies ahead for us with John A. Quelch, Dean of the Herbert Business School at the University of Miami. Thank you for joining us. It's wonderful to see you again. Happy New Year.
Happy New Year to you.
Right, well, we've been very much looking forward to having this discussion with you, looking at all the trade trends and the business trends for this year. And well, as we expect COVID-19 to remain with us for the best part of the year, which industries do you think are going to continue to see a downturn? And also, which sectors do you think are going to grow this year?
Within various industry sectors, there are winners and losers. In some industries, of course, there are losers across the board. Clearly the restaurant industry, all hospitality and travel related companies have really suffered in this downturn. But many of them have pivoted better than others. And so in every industry, there's going to be a shakeout in terms of winners versus losers. Obviously, high technology is going to do well because remote telecommunications have become very much more important. In the real estate sector, it's a mixed proposition because, for example, residential real estate, if you're talking in the US about single family homes, the market there has been very strong as people move out of apartment buildings and condominium buildings. The condominium market in the residential real estate sector has been very soft. One of the key issues is whether or not the behaviors that consumers are adapting during this COVID period are going to stick for the long term, or whether or not they're going to revert back to their former behavior. In my opinion, the longer the COVID crisis continues, the less likely it is that people will revert back to their earlier behavior. And what I'm talking about these days is a 50-50 world going forward, in which, for example, 50% of your shopping is done online, 50% in person. 50% of your entertainment might be in your own home, and 50% might be outside the home. And 50% of your work might be done from home, and 50% at the office or in the factory. So we're going to see a significant shift, I believe, in the long term towards more of this 50-50 environment where individual businesses will have to be able to cater to consumers who want to receive their products and services either remotely or in person. Businesses are going to have to become, as we say in the US, ambidextrous.
So really, this 50-50 trend that you're talking about, so some of the trends we've seen this year, like digitalization of entertainment or even shopping, is going to grow rather permanent. And well, businesses, of course, as you mentioned, they're going to have to make a lot of adjustments. And which industries do you think have been hit hardest by the disruption to global supply chains in particular over the course of the pandemic? And how do you think these businesses are really going to have to adjust their business models?
There's no doubt that the combination of the tariff wars initiated by President Trump, as well as the COVID crisis, have significantly disrupted supply chains. And the reason for that is that these very long global supply chains depend on predictability. The whole concept of just-in-time inventory that emanated from Japan 30 years ago depends on predictability. And when you have a crisis such as COVID has inflicted on the world economy, you don't have that predictability of demand anymore. And you don't know when the demand rebound is going to occur, and you don't know whether or not the demand rebound is going to be strong in the sense of restoring all of the lost demand that occurred during the shutdown. So, which have been most disrupted? Well, certainly the auto parts sector is one that depends on very long international supply chains, and particularly where companies were depending upon one source of supply or depending upon one country to deliver the supply of a particular component, you know, that the risks of doing that have been exposed by COVID. Another point I would make is that supply chains have been particularly disrupted in emerging economies, and trading supply chains between, you know, for example, Latin America and the rest of the world have been severely disrupted by COVID. And that will affect the availability of certain commodities, such as steel or cement. You know, there are some countries and industries that are dependent upon these suppliers from countries where disruption has occurred, and they are going to be looking for supply in different places. And I think what's going to happen here is that, frankly, China, which has done a pretty good job of managing through the virus and which has its supply chains largely back on track, China, to the extent that it has the same commodities that are being disrupted elsewhere in the world, may be able to take advantage and build its global market share.
And now, well, over the course of the pandemic, countries they did become rather wary of China and its rather controversial practices when it comes to security standards or intellectual property rights and, of course, human rights in their own borders. But while China, it seems to have been really actively striking up new trade and investment deals, signing the landmark RCEP deal last year and earlier this month an investment deal with the European Union. Do you think this would really help China gain the upper hand in the US-China trade war before Biden takes office?
Well, I'm not sure about the upper hand, but certainly there's no doubt that China adroitly took advantage of the clumsy trade policy of President Trump to negotiate and push forward these deals while Trump was still in office. So let me take each of them in turn. So when Trump came into office, you may recall that the previous Obama administration was well on the way to negotiate the TPP, the Trans-Pacific Partnership. And Trump unwisely blew that off in the very early stages of his administration. This then left a certain vacuum which China was able to fulfill. Now, let's not overestimate China here, because the other ASEAN countries and other countries in the Asia-Pacific region that ended up signing the RCEP, you know, these countries all wanted to get a trading relationship going with each other in a more formalized fashion, extending the trade agreement beyond the ASEAN bloc to a much broader and larger regional market. And China was able, I think, to take the initiative when the US dropped the ball and press forward with the encouragement, in particular, I would say, of Singapore to effect this deal 2 months before the transition of power in the United States. If we turn to the European Union deal, this was signed on December 30th. And received practically no attention in the international media, but it's a hugely important deal between the 27 member countries of the EU and China. And this particular deal was 7 years in the making. It again looked like it was going nowhere, but unfortunately, President Trump made a few ill-advised comments about the European Union that were taken as being somewhat insulting by our European allies. And that again gave China the opportunity to step forward. The European Union wanted the China deal, especially Germany, which has huge investments in automobile plants in China. They wanted the deal by December 31st. That was the date on which their presidency of the European Union, the rotating presidency, ended. And Germany wanted to get that deal through before the end of 2020, which they did. And China had to make a lot of concessions in the last week in order to get the deal done. The concessions being mainly in the areas of human rights and other issues that the French President Macron was particularly concerned about. But China saw the advantage of doing this deal before Biden came in, and Biden, of course, will repair EU-China relations, I beg your pardon, EU-US relations, but China, seeing that coming, wanted to get the deal done before Biden had a chance to do so.
And how do you see incoming President Biden handling the US-China trade war? Do you think he's going to be tough like Trump was?
So two comments on that. I think, first of all, the incoming President Biden has an enormous number of things that he has to tackle, particularly the national strategy for dealing with the pandemic and the economic fallout from the pandemic. As you and your viewers may know, there was an effort made to legislate a $2,000 per person stimulus for anyone earning $75,000 or under. This was essentially passed through the House of Representatives. It was on its way to the president. The president really didn't back it, but then subsequently, after it had failed, he decided he was going to back it, but that was too little too late. My point is that the Biden administration is going to be wrestling with a lot of domestic issues related to the pandemic and the domestic economy. The degree to which there will be bandwidth to handle China, I question whether or not in the early days there's going to be much change of policy publicly. What I do believe will happen is that the Biden administration will seek to restore the dialogues that are so necessary to this bilateral relationship and restore those dialogues on the basis of a climate of mutual respect rather than public recrimination.
Over the course of this US-China trade dispute, a lot of countries like EU countries and South Korea, they've been really stuck in the middle. Of course, Australia is also a huge example. But how should these countries then, like South Korea, really balance these concerns about trading with China? For instance, security concerns, intellectual property rights, also human rights, while also profiting from the trade relations?
Well, first of all, the Australia example is a very instructive example because Australia, in many respects, in the 2000s, was pivoting economically towards Asia and towards China in particular, both China trade and China investment. And more recently, with the alignment of the administration in Australia with the security concerns articulated by President Trump, Australia has, of course, taken a much tougher line with respect to China, and especially with respect to demanding a full and thorough investigation of the origins of the COVID virus. China has responded to that by punishing Australia with a variety of trade measures that are quite hurtful to Australia, in the sense that Australia, for example, in the case of barley, does not have that many other large-scale international customers to whom it can turn. So I think what China is doing with its policy towards Australia is basically sending a signal to other mid-sized economies in the region that if you align too closely and too publicly with a very tough-minded U.S., that you're going to pay some price for doing that. And that's leverage. That's what China is communicating. My belief is that these mid-range economies do have to tread a very careful path between, on the one hand, not denying the absolute importance of intellectual property rights and, in some respects, human rights issues as well, but they must at the same time get along with China. You know, we all have to do that in our personal lives and in our work lives many times. You know, we know that sometimes you have to get along with a boss who, you know, is not that pleasing to you in the way he or she may behave. But, you know, that's the law of the jungle, as it were, that applies in international trade as well as in personal relationships.
Right, so they really need to find that point of compromise. And well, I'm afraid we're out of time, so this is where we're going to have to end the discussion today. But that was John A. Quelch, Dean of the Herbert Business School at the University of Miami in the United States. Thank you so much for your time.
Thank you. Happy New Year.
Happy New Year to you too. And to our viewers, thank you as always for watching.